Hey there, it's J Rod here with Zach Scheid. Zach and I were just saying ahead of the call, we've been doing this for I think a year now, and we've never had a lack of good, content to talk about. And just like every other month, we got a lot of great stuff on the docket, a lot of good stuff, a lot of stuff, people are sending in their concerns about. But as always, you get to sit down with Zach and cut through all the noise and get right to what matters. Zach, how
Yeah,
are you, man?
I'm doing well. Yeah, I thought you were going to say, we've never had a lack of content, and this week nothing's going on, except that's not
Nothing.
at all what's happening. There's a lot going on in the market, which is why I love my job, I love my team, and I love you guys out there because we're all in this together. There's a lot going on. We've all got our goals as far as how we want to build our retirement wealth. We want to build the income that we can pull from markets. And while some days are more challenging than others, the truth is that the volatility in this market, the changes that we're seeing actually create opportunities for us as we see what's going on and we get kind of ahead of the curve, ahead of these trends. And so I am excited, despite the fact that we have had some questions that have come in, legitimate concerns that people have about this market. And I'm excited to get a chance to address those and kind of talk about how we can protect ourselves and how we can actually profit from this environment. So I'm going to go over the cliff notes real quick about what we are seeing, what we've been talking about, and then we'll jump into some actual changes that you can make right now to benefit and to protect yourself from what's going on. So during the coronavirus crisis, we saw certain speculative areas of the market move really sharply higher. And these are all exciting areas. The work from home trade was big. A lot of the digital companies like Peloton, Zoom, the companies that made their business grow as they came into your home and helped you survive the pandemic. Those stocks have done quite well. We've also seen surges in companies that are associated with autonomous driving, artificial intelligence, solar energy, the cannabis industry, space exploration, and there are several others, but these are some big themes that have driven some, we'll call them speculative stocks, sharply higher. And whenever you have this kind of a situation, there are opportunities to make a lot of money as these stocks move higher. But it's important to kind of take a look at who is driving, we'll call it who's driving the bus right now. Or was driving the bus as these names moved higher. And to a large degree, it was the individual investors, people who received stimulus checks and wanted to put it to work in the market in areas that they were excited about. And so these individual investors poured money into popular names that were exciting, but didn't necessarily have the best of business models to generate profits over the long term. We've seen this story time and time again. And it creates opportunities on the way up, but it also creates risks when we start to see kind of a differentiation of which of these companies are legitimate, great tech companies that have long-term prospects, and which of these companies are sort of flash in the pan. They were exciting, but now we start to see they don't quite have what it takes to survive and to generate profits throughout the market. I love these kind of opportunities. J-Rod, you and I have talked about how we've got this formula, and we talk about how income, which is kind of our basis for investing, we want to generate income from markets plus growth. These are the speculative areas of the market that that are growing at any one particular point in time in the market. If you put those two together, it equals boom, or it equals wealth. It equals an opportunity to grow your wealth, to grow your retirement, to grow your financial stability. And so this is definitely something that we'll keep looking at, even as the shifts in the market kind of cause risks and new opportunities in different areas. So as we warned, and we've been talking about this a little bit, the trend is shifting, and stocks that were too expensive are now starting to pull back. And over just the last week or two, we've seen them pull back in a big way. Yet not yesterday, Friday. Maybe it was Monday. I'm getting my days mixed up. I think it was Monday. The NASDAQ actually entered what they call correction territory. And it's sort of an arbitrary thing, but the NASDAQ closed 10% below the highest close that it had before. And that's a kind of a warning sign that some of these speculative stocks, the tech names in these areas that we've talked about, are starting to pull back, and it's starting to instill some fear in the markets. And we saw a rebound from that point, but there's still concern there. And today there's actually multiple factors converging to make this trend away from some of these speculative tech stocks even more pronounced. And as investors, if we ignore these trends, if we ignore these factors, we're doing so at our own peril. So it may not be the popular thing to say, we've got some risk. If I start talking about one of your favorite stocks, and I've done this with friends, if I start talking about some of your favorite stocks and I'm not saying good things, you may be offended, and I apologize. I don't want to offend anybody by talking down about some of your favorite plays, but it makes sense to actually be aware of the risks that are in place, and to adjust the way that we are positioned so that we don't ride this train all the way back down and lose money that we've made through the last several months as these stocks have moved higher. So I will tell you, I'm not a doom and gloomer. I think that there's a lot of opportunity. I think there's some great ways to build wealth, but I do think that many retirees are going to be hurt by this shift if they're not paying attention to what's going on. And on this call, I don't want you to be one of those retirees who's hurt, or one of those investors who is hurt by this. So please pay attention to these shifts that we're seeing in the market. And that's my alarm. Sorry about that. Pay attention to these shifts that we're seeing in the market so that you're not one of those people that are hurt by these shifts. So one of the biggest catalysts that's causing a change in the market right now is interest rates. And we're seeing a surge in market interest rates that we haven't seen up to this point. In the overall bull market throughout the financial crisis, or the COVID crisis, we haven't seen this type of surge, and it's really kicking in now and causing some changes. So we know that the Fed, Jerome Powell, is basically continuing to tell us that they are working on keeping interest rates lower. The short-term interest rates that the Fed actually has control over are still near zero. But we need to understand that the Fed doesn't have as much control over long-term interest rates. And those long-term interest rates are affected by the market, by supply and demand. And specifically, we need to look at the 10-year yield on treasuries and the 30-year yield on Treasury bonds. And those are some of the most important market interest rates that tell us what's going on, where people are putting their capital to work, and how that's going to affect the economy. So higher interest rates naturally occur when the economy is growing. And there's a lot of different technical forces behind here. And we don't need to get into all those. It's not important to understand all the intricacies of the bond market in order to survive and thrive in your retirement. But we do need to know that when the market and when the economy is expanding, there's more demand for capital. People have more use for money. They can use it to open factories. They can use it to hire new workers. They can use money to start new businesses. And so because there's more demand for money, it causes interest rates to rise simply because there are more people willing to borrow. And when you have more people that are willing to borrow, banks and other lenders have a little bit more leverage, and they can charge a higher interest rate. So that's actually a big part of what we're seeing in the interest rate market right now. It's a good sign for the economy, right? Because there's more demand for capital, and interest rates rising tell us that the economy is doing well. So the yield right now, or the interest rate on the 10-year Treasury, has been surging higher, partly as people kind of get ready for and start to anticipate the reopening of our economy after the coronavirus crisis. Mm-hmm. But this is a serious problem, the higher interest rates. It's a serious problem for A, stocks that don't have earnings, and B, stocks that pay no dividends. And that's simply because as the 10-year yield rises and as other bond yields rise, it gives investors other opportunities to invest in different things like the 10-year yield that can pay a little bit more reliably and actually now pay something that's a little bit more meaningful than what we saw before. So just to kind of put this into perspective, the 10-year yield currently yields about 1.55%. That's the number that I saw just before we jumped on this call. And this is after pushing a little bit above 1.6% earlier this week. Mm-hmm. This compares to the 10-year yield was actually closer to 0.5% throughout much of last year. So that's
big move higher.
Yeah, it's literally triple what we saw during midway through the year last year. So even though it sounds somewhat small, just a 1% increase in the interest rate, think about it in terms of, it's triple what it was before. That's a big rise. And basically, as interest rates rise, these investors have better options for where they can put their money, and it naturally causes a lot of capital to move out of the speculative tech areas that we've seen just so popular over the last several years. So that's a big part of what's driving this change right now. Keep in mind that when rates go higher, bond prices go lower. This is something that we've warned you guys about, and hopefully in your own retirement account, you've been able to stay away from Treasury bonds because as interest rates move higher, long-term Treasury bond prices, what you can get if you sell your bonds right now, trends sharply lower. And because these are longer-term bonds, a 1% increase in the yield actually causes a much bigger percent drop in what your bonds are worth. In fact, the 10 year is about a 9 delta, which is simply technical speak for if a 1%, if yields increase by 1%, the bond price decreases by 9%. And the 20 and 30 year bonds are much higher than that. So it's a big area of risk. And quite honestly, I want to tell you, even though we've already seen this surge, there could be, and there likely will be much more movement in interest rates. Keep in mind, as recently as 2018, the 10-year yield was 3.25%. So that's still well above where we are. It's more than double where we are at 1.5 right now. And then farther back in history, like in the 1990s, we saw interest rates between 6 and 9%. And that was when the economy was booming, which ironically is what we're kind of expecting for the next several months. So as we emerge from the coronavirus crisis. So it is an area that I want you to avoid: long-term Treasury bonds and funds that you're invested in that your broker or your financial advisor may, just by default put you into. Those could be very dangerous. So look through your account and make sure that you're not invested in those areas. Kind of the flip side of this coin, we talked about higher interest rates. The other side of this very same coin is the fact that inflation expectations are moving higher. These kind of things they go hand in hand together. And so while the Fed continues to state, they're telling you that inflation is under control, we're actually seeing more and more signs of inflation picking up, and signs of future inflation being significantly higher. Now, this is kind of a new trend, and it's definitely associated with the economy picking back up, but it's also driven by changes in Washington. So one of the things that's driving inflation higher is the overall economic recovery. As vaccinations rolls out and municipalities start relaxing some of their rules on who can get together and when, we're starting to see businesses come back up and running. Commerce, people are moving around, travel, all of these things are picking back up. People going to restaurants, and people are spending money, and that's actually a really good thing for our economy. Also, there's more money on the way. Even as the economy starts rolling again, Washington is kind of preparing to send out more money. And the interesting thing is, we're actually going to see more stimulus money or more recovery money, or however you want to characterize it. The government is putting more money into the economy now, while we're already recovering, than it did during the peak of the peak of the coronavirus crisis. So as more money comes in, there's basically more people and businesses trying to spend money, and that's creating some competition as far as who can buy the limited number of goods and services that are available, because there's a lot of money chasing after those. At the same time, some of these policies in Washington are making it easier for people to not work, and are actually helping to create a situation where businesses are, well, let's just say, we understand that there's help being given to people who are not able to find work, but sometimes that help can create disincentives to work, and that causes businesses to be less productive, and it causes less things to actually be created, less services available to customers. And so and I'm not trying to make a political statement here. I know people need help with the crisis that we've got going on, and I wouldn't want to be the one trying to make the decision as to how the money gets allocated and who gets what. And it's a difficult decision, to be sure. And so I'm not taking a stand on one or the other side of the aisle, but I do want to tell you how this is going to affect your retirement, how it's going to affect your life, how it's going to affect markets, and how we invest. So with fewer people working, with businesses being less productive, there's naturally fewer things to buy, fewer cruises that are going out, fewer restaurants that can serve. Restaurants are serving at a limited capacity. Meanwhile, there's a lot of money that wants to buy these things. So this is kind of a perfect storm scenario for inflation. Economics 101 tells us that when there are fewer things available or less supply, and there's more of a desire to buy things, there's more demand, prices will naturally move higher. And so that's exactly what we're expecting to see, what many economists are expecting to see over the next few months, sharply higher inflation. And that's something that we need to be concerned about with our retirement funds. Now, the Fed, basically, they're sticking with their song of, inflation is under control. And they have to do this. They have, sorry.
That's the Fed calling.
It's the Fed. They don't. They have to continue to try to tell us that inflation is under control, because if they don't, we could see the market move even sharply out of bonds and cause interest rates to move even higher more quickly, which would cause kind of a pause in our economic recovery. So in order to keep the economic recovery going, the Fed must tell us that inflation is under control. And that's exactly what they're doing. They're sticking with their playbook. But what this actually does is it leaves us with kind of a game of chicken between the Fed and the overall market. The market's saying, our economy is increasing. There's more money sloshing around being available to spend. There's fewer goods and services. Obviously, inflation is coming into play. The Fed's saying, no, we got this under control. No, we're gonna keep helping out to keep interest rates lower. The honest truth is that at some point, the economy, the true economy, the market, the true market, that's what's going to actually determine where interest rates are. And the Fed has a limited and short-term ability to keep interest rates where they are. So I do expect inflation, I do expect interest rates to move higher. The question for you is, are you prepared for this inflation? And what are you doing to protect your wealth and your retirement investments from this trend? J-Rod, that's what I've got for today. It's a lot. I know I've been talking a lot, and I hope I haven't overstayed my welcome, but just wanted to make sure that we got all of that information out because it's important right now.
It is, and that's you hit on so many of the areas that we're both hearing from, from friends, family, from readers, like you here. That's great synopsis. Great stuff.
Good.
Great. Well, that's about all the time we have for today's call. But any final thoughts before we wrap up?
I just echo that we're going to make changes on a gradual level. So please don't go out and sell the farm and sell the stocks and buy the farm, whatever. Don't do it all at once. But let's make this gradual shift so that we're all in the same boat, generating wealth, sticking with our income plan, and really surviving and doing well in this market.
Well put, Zach. Well, thank you so much for your time. As always, I'm J-Rod, and we'll see you next time.
See you guys.